Goldman Sachs says risks of major stocks drawdown modest for now. What we want to try to answer this question is whether or not Goldman Sachs continues to run Wall Street, the stock market, and Fed policy. That's the biggest question we have this weekend. So if you're enjoying the stream at any time, I would really appreciate a thumbs up. And as you're probably noticing, this video is coming out one day later. Going forward, we are going to publish these videos on Sunday to give myself a little bit more time to prepare the video and to get it going. I want to start this as well by just saying that last weekend I was looking for a sizable move down and it just did not happen. I was quite surprised. I was looking for a bull scenario was my base case, and then after I saw that massive crypto drop, I was really confused. I'm still confused this week, but I have a lot more clarity in terms of where we could go. I do have a bull case and I have a bear case, and I'm going to go through those in this video. And what I want to try to do is just outline what I think is most important as we go into this week, and then look at the evidence to support it. First thing I just want to look at here is going to be that 5 stocks contributed to more than half of the S&P 500 returns since April. And if that's the case, we have to make sure that those 5 stocks continue to be very strong and that they show no signs of weakness. Why? If there's chinks in the armor, we have to be mindful of that. What's really interesting too is that they're no longer quoting the FANG MGs, Facebook, Amazon, Apple, Netflix, Google, Microsoft. What are they quoting now? Again, Goldman Sachs is talking about how just 5 stocks, Apple, Microsoft, Alphabet, and Nvidia, and Tesla. Interesting. So Nvidia and Tesla are joining the pack, and Facebook and Amazon kicked to the curb, right? Very interesting. And the reason why I say that is because here, again, together account for more than 1/3 of the gage's returns this year and more than 1/5 of its total market capitalization, according to the strategist. What does that mean? It means that this block, this one, and this one are big. They're really important. And what I just want to look at here really fast is just what's been happening year to date. So again, looking at year to date here, it's pretty obvious, right? We see that 35% here for Apple, 54% for Microsoft, 131% for Nvidia, 68% for Google, and then Tesla at 44%. What I want to do now is just actually start looking at shorter time frames to see whether or not we're seeing some chinks in the armor, or if we have to be mindful of anything. And again, the purpose of this video is not to go through individual companies, but to look at this holistically, top down. So again, we can still see here that Nvidia is still doing roughly 2x of what Apple and Microsoft are doing. Google red in line at roughly 20. Tesla is up by 65. So there's different leadership between these ones, but for the most part, it's pretty consistent like it was since the beginning of the year. Now let's look at the last 3 months. Looks like Apple's starting to pull ahead. Nvidia is actually right in line here with Tesla at 36%. Google softening up. Microsoft a little bit less bright green. And Apple, again, definitely pulling ahead. Biggest block, biggest percent gain. So again, Apple is pretty much putting the team on its back here. Looking at the 1 month, oof, right? This is where it no longer looks like a 5-trick pony. It looks like a 1-trick pony. Why? Tesla is red in the last 30 days by 5%. Microsoft, it's not bad, but it's not bright green. It's up 3.5%. Nvidia only up by 2.5%. It's not even the leader among the group like it is on almost every other time frame. Apple crushing it, 21%. And again, the biggest block. So if we're gonna really hold all the way through to 2022 and only 5 stocks are really holding us up, we better make sure that Apple holds up and that the rest of the team starts to join the party to drag it even higher. Why? Again, now looking at a 1-week performance, we start to see those same names pulling back ahead here. We see that Nvidia is red, Tesla is flat, Microsoft is starting to pull ahead, and Apple is there. Google is up by 4. So again, I'm noticing that there is definitely some rotation happening between those names, and there's also rotation happening between the companies that really dominate the S&P and the NASDAQ, notably Facebook and Amazon removed, and then slotted in with Tesla and Nvidia. And whether you like these companies or not, this is what Goldman Sachs is quoting. So for me, it's super important. I'm just going to try to be mindful of time here, so I'm now going to start skipping forward. And again, if you're really enjoying the stream, I would really appreciate a thumbs up and drop me a comment. Are you bullish? Are you bearish? Where are we going to go? I can see us potentially pushing down to 430 or as high as 490. And I'm talking, it is not going to be a boring meeting on Wednesday when the Federal Reserve, Jerome Powell, speak. I don't think it's going to be boring. I think we're going to get a dramatic move one way or the other. I honestly just don't know which way. I think it would be much healthier for the sustainability of the market and everything else if we did take a haircut now and then reset. However, as we're going to note in a couple of articles a little bit lower, Jerome Powell has been there, done that in 2018, and we're not sure whether or not he learned his lesson or if he wants to repeat the same thing he did last time. So first thing I just want to point out here is that we have a busy economic week with 3 stars, which means that there's a lot of economic data coming out this week. When I zoom out, this is a long sheet. I had to zoom out to get it all on there. There's the most important central banks are all going to be speaking. That includes the Fed, the ECB, and the BOJ. BOC reported last week, and there's some really interesting telltale signs in there. We also had the BOE, or the Bank of England, also report, which was widely expected to signal some kind of rate rise, and they didn't. They held pat. So I think the same thing is likely what we're going to get out of the Fed as I look further, but I don't know if that is what we're going to get. So we just have to be prepared for the up, the down, and the sideways. So on Monday, here on Tuesday, we're going to be getting PPI number. Again, that number is important, but if the market did not do anything regarding CPI on Friday, I don't know what's going to do anything with this one here. And the reason I say that is because the market got exactly what was expected. Nearly 40-year high inflation was expected. The market's like, cool, it's in line. It's not a beat, all-time high. Record close on the daily, record close on the weekly. Not a record intraday high, but a record close. So what that means is that the expectations were aligned with what the market thought, and it took a cue to go up. So if the market is already expecting 2 to 3 rate hikes out of Jerome Powell and an increase in the taper, the question is, are we set for that same bullish reaction when expectations are the reality? That's the big question. That's the easiest way for us to summarize it. The market is expecting more taper. It is expecting 2 to 3 rate hikes next year. So if Jerome Powell walks the line and he's calm, cool, collected, that might just be enough for us to go higher. I don't know if he wants to try to create some kind of turmoil. He turned pretty hawkish at the last meeting. So again, just really unsure. Looking forward to Wednesday, we got core retail sales, we got the FOMC, we got the big one here. Why? We got economic projections, we got the statement, we got the interest rate decision, and then we got the press conference. So what's going to be very interesting this time is that at 2 o'clock, we're not only going to be getting the interest rate decision and the statement, but also the economic projections. And there's been people from every side, experts including Larry Summers, Bill Dudley, executives, all talking about what they think is going to happen. So again, Wednesday afternoon is definitely going to be the focus for this week. Looking forward to the rest of the week, now we have the ECB and the BOJ following the Fed. The ECB is pretty much super dovish. They could go more dovish, but again, they're going to be following Jerome. They're going to be following him after they get the same thing in Europe that they got in the US. PMI, services PMI, right? All that fun stuff. So we got the BOE reporting here as well. I missed that one. BOJ, Bank of Japan. And then we've got CPI on a year-over-year here in Europe coming in. Again, 5%. That is huge. It's huge, right? But if that's what the market expects and that's what the market gets, maybe that's all we need. So jumping forward to here, again, Summers says policymakers may have now cemented inflation at 4%. The reason why that matters is because that's high. This might start runaway inflation where they're gonna have a really hard time pulling in the reins all the way back to 2%. However, with the way that the market is currently structured, I don't know the businesses or consumers are legitimately prepared for the burden of higher interest. I'm gonna go. So there's some articles here we're gonna go through again. Most of these are published in the last day. I'm recording this on. Oops. There we go. Weekend deep dive. It is the 11th of December. I had the wrong profile on it. My apologies. So most of these are from the last day. We got one here talking about Goldman Sachs' risks of major stock drawdown, modest for now. Again, they've been right for the most part, so why would we assume they're wrong? I even have a mathematical equation from a Fibonacci extension for this most recent drop, which gets us to their number, 510. So it's very interesting, right? Math lines up, just like it did last time. And I think that if they don't move this week, I think we're headed for our blow-off top. Again, I didn't trade through 2000, so all that I can do is read articles and look at history. And I'm seeing the setup here. If the Fed does not act and they do what everyone else has done, I think we're going to 500 on S&P, 5,000 on SPX. I think that's going to happen pretty fast too. My monthly candle pattern that I have coming up a little bit later shows the evidence for that. So again, if they're right, they've already called it. They already called 510 into next year. They've already called, right, not going to happen, not going to be a drawdown. Really interesting. So stock market bravado tested as bond flash Fed policy danger. The fastest inflation print in nearly 40 years is rattling nerves as Wall Street, where economically sensitive trades are hitched to an ultra-accommodative Federal Reserve. Interesting. Next one here is massive U.S. debts could trap Powell as Fed fights inflation. The U.S. went on a borrowing binge last year, and the hangover could make it harder for the Federal Reserve to tighten inflation without crashing the economy. What does that mean? I think Jerome wants to start raising rates. He wants to start getting aggressive. I don't know that it can actually be handled. That's the biggest question for me. So I think he wants to. I just don't know that he can. Again, Bill Dudley, former New York Fed chair, he is here talking about, again, if you're interested, go to the SPX channel, click on the article. It's an interview with him. This one's a little bit earlier in the week. Here's, again, former New York Federal Reserve President William Dudley, a Bloomberg opinion columnist, looks ahead to the upcoming Federal Reserve meeting as he sees earlier rate hikes and more rate hikes in the forecast. This guy is pretty educated on the subject matter. Why? He's the former New York Fed president. And what he's talking about is normalization through 2024. What does normalization mean? Where the interest rate and inflation are matched. That is neutral. Right now, we're seeing 6%. 4.9 on core CPI. Inflation's at 0. That's a gap of 5%. We either have to have interest rates come up to 0. We have to have inflation come down closer to 2%, or some of both, where they find equilibrium sometime between now and the end of 2024. That's what this means. So everyone's already calling for it. Looking here, we got U.S. debt spikes. The Fed's financial stability report published on November 2nd, right? What was that, like 6 weeks ago? Woo, forget about that, right? This market moves so fast. The key measures of vulnerability from business debt, including leverage and interest cover ratios, were back to pre-pandemic levels. What does that mean? Companies are not ready. They're not ready. They've had all this accommodation. We got record debt. No one's ready. Intense market volatility has swayed the Powell Fed before. Officials paused after raising rates in late 2018 in the face of severe swings in stocks and bonds and cut rates 3 times the following year. Oh, isn't that what everyone wants him to do? To raise rates now? But if he saw this thing happen in 2018, he did cause a market crash in 2018, by the way. He was the Grinch. Right into Christmas, he tanked the market. Why? The FOMC December meeting is always at the same time. So between now and end of the year, he caused a severe hangover. So the question is, does he want to, or does he need to do the same thing in 2018 that he needs to do now? Or did he learn from this lesson and see that, you know what, maybe I should be a little bit slower, a little bit more patient, because this time is even more important. Again, he was getting hawkish in 2018 and took it all back in 2019. That's what it's telling us here. He's already been through this before. So again, jumping forward to the last part here, again, I'm just taking screenshots from each one of these articles to try to tell you a little bit of a story versus just droning on and reading every little word. The fastest inflation print in nearly 40 years is rattling nerves as Wall Street with economic, again, we talked about this. The spread between the 5-year and 30-year Treasury yield, again, this basically is just a measure of how much do you think that interest rates are going to be high for 30 years or for 5 years? And as they start to get compressed, it just means that people don't want long-term debt. It's basically what it means, to make it super, super simple. So just jumping part to the part here that's underlined, with that curve now at the flattest since March of 2020. It's a sign bond traders are betting faster rate hikes will undercut the red-hot economic expansion, possibly disrupting the business cycle in the name of inflation fighting credibility. That is the biggest question here. Does the Fed want to remain credible, or are they trying to monetize the debt? What does monetizing debt mean? When people can't repay back their debt, again, pretend you own $1,000. Let's make this really simple. And if you're enjoying the stream, again, I really appreciate a thumbs up. If you owe $1,000, you can make it $1 million, right? Just pretend it's $1,000. If you can't afford your $1,000 payment today, Well, what if tomorrow, meaning like next year, in 5 years, that $1,000 is really only now worth about 500? What does that mean? Your debt load is reduced by half. Oh, so that's monetizing the debt. That's what we're talking about here. Why does it matter? Well, look at the next screenshot here. Record refinancing need. Amount of corporate debt maturing within the next 5 years is at an all-time high. Look at the numbers there too. IG is investment grade debt. That's the good shit. The pink ones, that's the bad shit. The blue ones, that's the really bad shit. So we have a look here again. It's ballooned from 2011 to where we are now. It's roughly doubled. And we look at what is making up the largest chunk of that. It's junk loans and junk bonds, which are going to be maturing in the next 5 years. What does that mean? There's going to need to be some refinancing. If they're refinancing at a higher rate, that could be potentially devastating. All right, so if companies are already under pressure and there's been record liquidity being pumped into the market, now the next thing to look at is, are people able to pay back the debt that they already owe? Talking about student loans here. Experts, lawmakers call for Biden to push back the return of student loan repayments. Again, didn't the same thing happen with the memorandum of people's rent, where it was pushed back for so long? Why? Because people are broke. They were broke before the lockdown happened. So again, looking to here, blah, 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 right? A new survey of 33,000 student loan borrowers from the Student Debt Crisis Center found that even among student loan borrowers with a full-time job, 89% say they're not financially secure enough to begin making payments after February 1. Whoa! 9 out of 10 people who are working a full-time job cannot repay back their student loans. Whoa. And 21% say they will never be financially secure enough to resume payments. Never. They're never paying this back. They're either going to forgive it, they're going to monetize it, meaning make the debts of today worth less tomorrow, or there's going to be some kind of, right? There's going to be some kind of debt bubble. Something's happening, right? The question is, can the economy actually afford this? So again, this is what we're looking at here now. Again, I'm trying to tell you a story. There's a lot of information. This is probably way over most people's heads. So I'm trying to just make sure that I'm striking a balance between providing information without trying to scare you, because we're going to know on Wednesday. We don't know who's going to be right or wrong. All we know is that Wednesday's the day. Thursday will be the confirmation. Friday's going to confirm it. More slowly. They may move a little bit more slowly to see how things develop and whether problems do come up in the U.S., at least in the non-financial corporate business sector. Again, says William English, professor at Yale School of Management and a former senior Fed economist. There will be just another source of uncertainty for monetary policy. Again, if they raise interest rates, that means that student loan borrowing becomes more expensive. The junk bonds are going to get a little bit junkier. All the stuff can be coming to fruition. So there's all this bad stuff brewing. I'm talking a shitstorm versus Goldman Sachs basically saying, whatever, right? We got the best companies in the world. We just need 5. That's all we need. Just a handful, right? A handful of companies, or 1% of the S&P 500. 5 out of 500 are basically going to be pulling the market up. That's the takeaway here. Hopefully you're seeing the story. Next thing I want to look at here is, again, that's the Bank of Canada governor, and the Bank of Canada moved last week. So what I just want to look at here is that the stage is set. If Jerome wants to get a little bit more hawkish, or big bad Jerome for stocks is the way to look at it, the Bank of Canada pretty much said what the Fed should say. Keyword there being should, not will. Should. Bank of Canada keep 2% inflation target in new mandate. The Bank of Canada will maintain its 2% inflation target in a mandate review that will be announced in coming days, according to a person familiar with the matter. What does that mean? 4% is unacceptable. 2% is the target. So 2% over a blended period. What does that mean? If it goes to 4, it has to come back down to 1 to settle out at 2. It can't stay above 2 for much longer. Oh, really? Yeah. That's just how numbers work. That's math. So right now, even with Canada, again, we're expecting 5 hikes baked in for the Bank of Canada in 2022. Right now, there's 2 to 3 for the U.S. And right now, the U.S. has 40-year high inflation. It is more inflationary than Canada, more inflationary than Europe, more inflationary than England. What does that mean? the Fed pretty much has to move if they want to remain credible on their fight for inflation. But what we've mentioned before, I think it was 3 or 4 weeks ago, is that it appears like the Fed is now got a third mandate. Their first mandate is price stability, inflation. Second one is full employment. Third one, market stability. So again, market stability meaning if he does what he did in 2018, he might be trying to go a little bit faster than he can and not to dial all the way back. And in the meantime, there's this huge uncertainty regarding the new virus and also what is happening with, did I not share the screenshot that I took here? Oh, here we go. Oopsies. Let me just upload that. Let me shoot that in there. Where was my train of thought? I forget now. So anyway, so the Bank of Canada has a 5 interest rates baked in for next year, and they're saying 2%, but they didn't raise rates. So the Bank of Canada today held its target overnight rate at the effective lower bound of 0.25%, with the bank rate at 0.5% and deposit rates at 0.25%. So we can look through here and glean a little bit of information from the BOC. Because again, what they're talking about here is pretty much what the Fed is going to say. The question is, does Jerome Powell think 2 or 3 is sufficient for 2022? Does he want more? Does he want less? Don't know. It's already been 21 minutes, so I'm gonna have to start going a little bit faster too. But again, there's a lot to digest through here, so I really encourage you to subscribe to the channel, smash a thumbs up, drop me a comment, and come back to our regular streams Monday to Friday to go through this. Again, I'm gonna go through the parts here that are highlighted because we could just read this all day. There's so much to go through. So CPI inflation to remain. This is from the Bank of Canada, by the way. So this is the equivalent of the Fed up here in Canada, right north of the border. And since we're so close to the US and our monetary policy is very similar, this should be a very good representation for what we can expect from the Fed. CPI inflation to remain elevated in the first half of... So this is basically the summary of economic projections equivalent from the Bank of Canada, which we're going to be getting on Wednesday from the Fed, and what Bill Dudley said that we should be recalibrating right now. And so did Larry Summers, the former U.S. Secretary, basically Janet Yellen's job right now. These guys know what they're talking about. Will the Fed do what they need to? I don't know. I just want to make money too, right? If the market starts to move higher, I'm not going to be hesitating. I'm going long. I'm going to make money. Blow off top. Let's go, right? 5,000, 1,500, 5,500, whatever it takes. Let's just go up. CPI inflation remains elevated in the first half of 2022 and ease back towards 2% in the second half of the year. What does that mean? They're not going to do anything until the second half of next year. What is that? That's like 6-7 months away. That's an eternity, right? That's a lot of time to be sitting on the sidelines. So the governing council judged the review, blah, 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 excess capacity, blah, 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 oil, blah, blah, blah. They remain committed to holding the policy interest rates at an effective lower bound until economic slack is absorbed so that the 2% inflation rate target is sustainably achieved. Okay. In the bank's October projection, this happens sometime in the middle quarters of 2022. We will provide that appropriate degree of monetary policy stimulus to support the recovery and achieve inflation targets. That's all the Fed has to say. They basically go copy, paste, Federal Reserve, boom, we go up. That's what I'm saying here. This is what I think that what the U.S. is going to do. I think Jerome should move. I don't know if he actually can. So at a high level, that's what I'm going through this week. It's a lot of calendar of events. Why? It's really, 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 really important. All right, right about the 23-minute mark here. I'm just going to go through a little bit faster, and then at the very end, I'm going to summarize my thoughts one more time and just leave you with a little bit of a tidbit. Again, tidbit is, that's a Canadian thing. I'll just ignore it. Anyways, going through here. I think where I want to go to next is actually going to have a look at the... we already talked about the heat map, right? Everything's bright green in the 1 week. 1, 3, and 1 month and 3 month are lacking the everything rally that I would want to see, generally seen for a Santa Claus rally. But 5 companies delivered more than half of the S&P's returns since April. So is Amazon going to join the party? Is Facebook going to join the party? And if they do, that could be enough. The other 5 stay flat, right? Nvidia, Tesla, and Apple, Microsoft, and Google, they stay flat. Other ones go up. Boom. Market rallies. Nice. All right. Let's go through these ETFs. So what's going to be super, 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 and I use that word intentionally here, super important, is going to be this QQQ chart as we go through all the way to Friday. Why? QQQ is the Invesco managed again, Invesco managed trust for tech. It is different than XLK. Every other chart we look at starts with XL because it is spider managed. XLF, XLV, right? Then we also got XLU, XLE. We got all the XLs because those are the ones we generally track. However, QQQ and XLK have different weightings in terms of the top holdings. So in my opinion, QQQ provides a better representation of the 5 companies that are driving the market higher. And if we have a look here again, we have a higher low bouncing off of the previous all-time high, roughly 383. We have a head and shoulders at 400, generally a bearish pattern. And we're back at 400 resistance. What does that mean? We have to basically close above 400 to invalidate this pattern, and then it's all systems go once we clear that 410. And that 410 is notably important because of the Friday options chain, where we have a 400 straddle with roughly $10 in premium attached. What does that mean? Just stay tuned and I'll tell you what it means. But I would really appreciate your thumbs up, and that's great. All right, XLF. Again, we got a pennant here. It's not doing a whole bunch of anything, right? Faded over 3 weeks, bounced back. Not sure what it wants to do. Pretty nice close. Looking at XLV or healthcare, we got a bull break off the apex. We have roughly an inverse head and shoulders with a 129 neckline, right? So head, shoulder, shoulder, bounce. Nice. Looking at DIA or the Dow, nice snapback and pivot off of 350. So we gap up to 350 and just go. Close at the high of the week. Nice. IWM. Inside bar, slightly higher high, basically a higher low, micro lower high. It's a tight inside bar. It just rejected basically last week's high. Stalled out on the downtrend and just below the 50 DMA. It's technically going to break that downtrend if we open above 220 next week. So I'm looking for a bull break or a bear breakdown, basically breaking the inside bar. That's what I'm looking for. Next one we got to look at here is utilities. Utilities continue to climb up, approaching your record highs here, right? This one's been unfazed the last couple of weeks, just wants to go up. Volume's also coming in. It's notable. Bull breaking. Energy, again, that thing that everyone's talking about, right? Bank of Canada, Joe Biden. Oh, well, the CPI from November doesn't include the right? And oil's going down. We got a 20-cent reduction nationwide, blah, blah, blah. Tell XLE. It doesn't even care. It's up 4%. As good as SPY is doing, XLE is doing better. I think the fact that they're releasing from the strategic reserve signifies that there's a real problem. It's real. And this goes back to supply and demand. There's not a whole bunch of supply, but as the world goes back to normalizing, driving to work, flying on planes, there's a whole bunch of demand. And this Green New Deal is a really nice idea. But in the meantime, if you want to get to work and you got a gas car, you need some gas. You want to hop in a plane? Need some gas. Want to turn on your power plants? Probably need some gas. What does that mean? Gas prices going up. NYSE. So looking at the New York Stock Exchange on average, roughly 2,000 stocks in here. Again, similar to the Russell, but it's just the NYSE. All stocks in the NYSE. What we see here is a pretty nice bull break. Huge bounce off the 50, closing up about 3% on the week. It's huge. I forgot to mention too, the S&P had its best 2-day snapback ever since like last year. Best 2-day record gain. So right back up. Record close as well. Record daily close, record weekly close. Looking at, moving forward back to here. So we just looked at the New York Stock Exchange. Now we're going to look at RSP, which is equal weight S&P. It's pretty close to its all-time high right now. So it looks really similar to QQQ, where in the short term, we've got a head and shoulders. So if we look here, right, head, shoulder, shoulder, but it's a little bit higher. So RSP is actually a little bit stronger, or the average S&P 500 stock is actually a little bit stronger than tech right now. A little bit, right? Not a lot, just a little bit. Next one here, TNX, or the 10-year Treasury note. It is pumped, right? Huge week, up 11%, 10.87. It's also back inside the weekly channel and over the 50 moving average. What does that mean? This could be the start of a massive rally here. 15 on the TNX basically means a 1.5% yield on the 10-year Treasury note. Inflation's at 5 to 6.7%. You're getting paid 1.5. What does that mean? You lose the difference. Guaranteed. Over the next 10 years, if it remains that high. Being neutral, like Bill Dudley was talking about, means that either we have to lower the real inflation rate to 1.5, or that 10-year note has to raise to meet the current level of inflation, or they both have to do a little bit of work. Inflation has to come down and yields have to go up to find that neutral range, right? Neutral. That's what we need right now. We need neutral. VIX, it got stomped. It got stomped so hard. 40% decline. Right back to test the breakout area here. Actually, also just below the 50 weekly moving average here as well. I'm noticing some really interesting activity between gold and Bitcoin as well, where if we're really seeing inflation, isn't Bitcoin supposed to be the inflation silver bullet, where they can't print more of it? And the more inflation we see, the higher crypto should go? Crypto needs a memo. One more time, crypto needs the memo that inflation is high. The whole reason why people say crypto is supposed to be doing well in this part of the bull cycle is because it's supposed to be fighting inflation. I don't see it. I don't see it. What do people want? Well, gold is finding some support here. IHS is holding, and I'm expecting a big move on this one here this week. Up or down? I don't know. Expecting a massive move, though. I'm leaning on the upside. We have a look here at Bitcoin on the weekly. It tanked 14%, lost 8,000 bucks as I'm recording this video. SOS, there's all this inflation, 40-year high inflation, and crypto can't catch a bid. WTF. What's going on? What's going on? Exactly. What is going on? And if we're truly seeing a tech-led rally, we should be seeing some of that build through to Arkk. Why? If tech is leading, so chips are leading tech, tech is leading SPY, and we're going to infinity, we should be seeing momentum catch a bid. Cathie Wood just can't catch a bid. All right, up 2.8%, but it got stomped into the later part of the week. It stalled out, just like IWM. Fear and greed, almost all the way back up to neutral after being at extreme fear, which I think means that we're baking in complacency. All right, moving forward. It's already been about 31 minutes. I'm going to start wrapping up now. I keep trying to make these videos a little bit shorter, but again, as we get closer to this big key decision, it's hard to rush these things. All right, looking at options now. Going to do this a little bit faster. Finally wrapping up with S&P here. So we got triple witching this week. So the fact that the VIX is getting absolutely stomped into here, it does not make sense to me unless Jerome is going to basically do what everyone else has done, and he's going to lose his credibility, which means that the market's going to listen to what he says, but they're not going to be listening. They're not going to think he's as credible. Why? He said the whole time, 3% is an overshoot. Well, for fuck's sake, we're at 5 to 7%. That's way more than 3. That's a huge overshoot. But Richard Clarida and other members of the Fed are echoing the exact same thing we heard from the BOC, where blah, 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 first half of 2022, blah, 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 second half of 2022. So that could be our blow off top between now and March, where the Fed is expected to end their taper in March. And then in March, they have to provide a summary of economic projections, basically meaning how they're going to raise interest rates. So if we're going to have a bull party, let's go. All the way from now until March, minimum. Looking here to the options chain, again, out to Monday, it's basically at the money. So we got 470 call versus 468 put, and 468 and 460 put volume and open interest here. So again, just a little bit, not really all that notable. Looking here to Wednesday, this is notable. We got a straddle here. I missed this. It wasn't here before. I missed it. December 15th, which is going to be the FOMC day, there's a straddle here, and it's got big dollars attached. So what I'm looking at here, and part of the move, which might be explained, is that this is hitting an open interest, which means that overnight it's getting burned. Why? Well, on this side here, they make $1.30. Over here, they lose $3.30. What does that mean? They lost $2 net net. That's a lot. So looking here at Wednesday, we have a 470 straddle with $5 in premium, but $7.50 if we include the overnight price because it's open interest, which basically means that we have to either be 7.5 points higher, 475.50, or we got to be at 463.50, 462.50, sorry. Oh, really? Yeah. And then what's really interesting to me is that that math also plays through to triple witching, which is going to be the monthly expiry for S&P on December 17th. That's this chain right here. I've gone wider just because it's more important that we look beyond the 16s. So looking here, we got that same 470 straddle. And again, same thing here, right? Gained $1.25 on the call side, stomped down by 370 on the put side. What's interesting here, though, too, is that they have reduced the 470 to 475 calls. So there was a spread put on here. 470 got largely closed out. It's notable. And what I'm looking at here is that We got a 476 open interest, roughly matches the 470 straddle for Wednesday payout. What does that mean? They're positioned for Wednesday, but they could manipulate it to close it at roughly at 470 and then let it go, either up or down. Why? We talked about the numbers that are payout. 476, that open interest right there pretty much offsets all of the straddle from Wednesday. Oh, so if we get a big move into Wednesday or a follow through into Friday, these guys are going to get paid. Looking on the put side, 460 open interest roughly also matches that 470 straddle payout. It's a little bit too high though, right? It'd have to be around 462 to really match the numbers there. But anyways, the motivation's there. And as I look further here, again, we got, this is December 31st, which is going to be the end of the year or the quarterly for QQQ. This one's just a weekly one, but again, last calendar day of the month. And then I'm also looking through to January of 2022. So what do we got here? It's pretty naked. The volatility is quite high right now, so buying options quite far out is pretty expensive. But the only thing people really want between now and end of the year, it's not 470, it's not 475, it's 465 with roughly $9 attached here, which means roughly 474, 475 break even for the end of the year. Our end of year target is 470. We're already there. Looking here to January, again, only thing that is notable to me is the 470 open interest. And again, here it's roughly $9 again. So what is that? Well, this one's 480 basically, 479, 480 break even. And again, I think a lot of people are just like me, where they're waiting on the sidelines, and we could get a huge gamma squeeze after the options open interest burns for next Friday. The bears are either gonna have to reload, or there might be more fresh call buying, which could gamma squeeze the S&P higher to force the market makers to buy the underlying, and I'm paying very close attention to it. Why? If the VIX is already crushed by 40%, why aren't people buying and loading up on 2022 if it's basically a guarantee? It's a little bit of a red flag for me that no one wants to add on risk into 2022 if it's free money. Everyone wants to trade the VIX. Looking here at QQQ, we're going to move forward now. Hold on. Where'd I get here? Oops, this is QQQ here. My bad. I copied and pasted and I went a little bit too fast. QQQ. Muted on Monday. Very muted on Wednesday. Very muted here. This is very unusual. Why? Well, if it's 5 companies driving the market higher, don't bet against them. Into December 17th, or monthly OPEX, though, here's where we notice that 470. And what's notable to me is that we got about... again, 395 spread right here. So straddle, sorry. So 27K, lots of volume on the put side. What does that mean? They got about $10 to break even. 385 or back to the previous all-time high, confirming the weekly head and shoulders, or busting to 405. What does that mean? Basically back to all-time highs. Blow off top underway. Now we look at the 400 straddle, 98,000, 74,000. Roughly $3 here, roughly $5 there, but we also lost about $3 overnight. What does that mean? The open interest lost that money. So here we got about $11 break even on the upside or the downside. What does that mean? 391 or 389 or all the way up to 411. Basically new all-time high into next Friday on QQQ if it plays out. Oh. Yeah. And then looking out here to January, so then we got 400 call open interest and 395 and 390 put volume. Again, pretty muted. It's basically just one strike, just like S&P. One naked open interest. It's naked. All right, reports are muted. Only VIX is notable. So what I did this week, which is new, is that I've actually looked at the VIX options chains for December and January because these guys are just going nuts buying this. And with a 40% stomp, people are making so much money off selling VIX right now. So what does that mean? Between 20 and 23 is max pain, and this one expires 1 week after the expiry for December triple witching, which is unusual. Usually VIX expires on the Wednesday and S&P expires on the Friday. This time it's different because we're going to be expiring the following week on the 22nd. So whatever happens, they're either going to try to jack up the volatility or jack it down. Right now we're at 18. We could go all the way back up to 23, or we could settle at about 18, and that's where the max pain is for me, between roughly 20 and 23. And then looking out here to the January one, again, similar, between 20 and 25. It gets a lot more muted, but you got fat stacks here at 19 and 18. and then a fat stack here at 25. Not a lot of premium attached because they're worth like a less than a buck. Over here we got them worth at about 250. But 20 to 25 seems like the maximum pain range for me, or all the way back down to 18 to cover off that spread. Whew, right? That's a lot of information there. So if that went over your head, just bear with me. I'm gonna wrap it up here. I'm gonna give you the bull and bear case now for the S&P, which is the thing that I'm most interested in. You'll notice some eyeballs here on this chart as well, because this is the most important one for me right now. First thing I'm trying to do is look at this with an abstract. Look at this without a preconceived notion of we're going to go higher or we're going to go lower. So what I notice is a similar pattern back to this green arrow here. Ironically, it also matches up with a similar time. That shouldn't be March of 20. Hold on. Yeah, sorry. So what I'm looking at here is the current candle that we're forming here. This hammer, to me, looks similar like the March candle that we see back here. However, the rally didn't start there. So what I'm looking at here is that we have a similar pattern to March of 21st for this month as we close here. As we close at 470.7 right now, this candle looks very similar to this one. During the whole expansion, there's not very many hammers, right? They look like this, where we're right near the high. This one's a hammer, but it's not as similar. This one looks very similar. So if history is repeating itself, and from here, we were at 320, then we went to basically 500, right? Woof. So the same thing can happen here, where we're setting up a fresh extension. Why? Why not? Goldman Sachs says up. So we got a power move off November 2020. That was the election here, right? Election night. And what happened here? Oh my God, it was October. It's 1 month off. Yeah, 1 month off. Power move in November. And then we go sideways for a few months with upper wick. So power move up, we go sideways, upper wick, and then there's the confirmation from the bulls. So what do we got here? Oh wow. So like this one candle looks just like this one if it was red. Yeah. So combine all three of those candles into one, you basically get that one. And what do we got here? We're basically reclaiming the previous top to make a new all-time high into the close of the month, open up the next month with a slight gap up, and then go. Oh geez. Oh geez. There's a Santa Claus rally and continuation into 2022 before we start starting to max out, and that's how we can get up to that 510. I'll show you as the math goes on here. You can probably even see it if you pause the video. So again, one more time. Massive green bar, November 2020. Massive green bar, October 2021. We get a move lower here on red. One massive red, so 2 bars turn into 1, 3 bars turn into 1. And then we got the reversal, which is what we're setting up for right now. Oh God. And then we get continuation, right? Yeah, we get continuation. Math for November 2020. Basically, what did we do here versus what can we reasonably assume is probable if we're repeating that same pattern this time, the blow off. This would be the blow off top for me. So looking here, we got 11% from the low to the high of this one single month. And then from the low here to the high of the hammer, what do we get? Roughly 28%. Sorry, from here all the way to the continued weeks, continued months. Sorry for mixing this up. So let me go through one more time here. 11% from low to high, and then from here all the way to the extension where we peak out before getting a little bit of chop with these lower tails. That's a 28% move. What's that? That's a factor of 250%. So the move that we did from here to here roughly finalized by roughly 250% all the way to the top where we start maxing out into here. So what does this do for the math for October? We got a 7.5% move from low to high, and then if we do that 250% multiplier, ironically, it gets us to basically 509.50. What's the Goldman Sachs target for 2022? It's 510. We talked about March of 2022 being when the Fed is going to be ending tapering and potentially looking to announce rate liftoff. So if we're going to be doing a blow off top, we have to finish it before March, in my opinion. So all the way up to 510, and then we decide, what does the Fed do? They remain more accommodative for longer. We grind up even more. They start to signal they're going to be raising rates. That's where we get the haircut. Interesting, huh? Yeah. Everything I walked you through before, the math lines up. Goldman Sachs has got the target. So again, it's hard for me to argue with this. I also don't really see a reason for the Fed to break from the pack of all the rest of the central bankers and say, whoa, 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 we're going to go first. I don't know. I think they should. I think it would be healthy. But again, I'm speaking from a position where I might know more than most people, and I think there's some real pain happening in the economy and for businesses right now. I think it's really tough out there. All right, so that's your monthly chart. Again, if you're enjoying the content, I would really appreciate a thumbs up, and make sure you come and watch our videos later this week, where we're going to be talking about commentary every single weekday at the market open. Weekly chart. All right, what do we got? We got a record weekly close. 485 is going to be our upper uptrend. So basically the top of the blue line here. It's also our next dotted line, or the 423% extension. What does that mean? We could be at 485 next week. No problem. Hit that upper uptrend. We did it before, right? Bottom, top, bottom, top, bottom, top, bottom, top, bottom, top, bottom, top, bottom, top. Yeah, it's reasonable. Why not? The daily chart, record close. IHS in a cup. So we got a record close on a 40-year high inflation print. Oh my God. So what could Jerome do? More up. We're already there. Blue sky breakout, basically. Just a couple more points and we're there. Less than 1%, right? Just a whisker away. So record close. This is an inverse head and shoulders. So again, I got a head, I got a shoulder, or a cup with a handle, and then the hammer to start confirming it. Here's where we can get the extension levels as well. So again, if you're looking for the last dip, was a very good predictor of the 161 extension, or the white line right here, which is where we peaked out before ultimately sliding back down. And now the blue lines are the new retracement from the new peak to the new trough, and the new dotted line up here, which is going to be our 161 dotted line, lines up with roughly 490, which means on this next impulse move, 485 is our weekly upper uptrend. 490 is going to be our 161 extension. What does that mean? We could hit it. We could hit it fast. I've never traded through a blow off top before, but the gains happen so fast to the upside. It's hard to know what's happening and what's going to lead a blow off top in the US, in my opinion. The 5 companies we just talked about before. No? Yeah. Monday at 3 p.m., we have an apex test for 471 and our old 161% extension. Green buying into the close too. What does that mean? No one's selling what they bought down here at 450. They're not selling it. We're 20 points higher, basically. They're not selling it. So why not? Maybe because we're going even higher. Yeah. Yeah. This is a long video. I wasn't planning on it being this long, but here we are. So again, biggest takeaways are that if the Fed does not move, it means that they're going to be losing some credibility in terms of inflation fighting. The bond market will reset, stock market will likely go higher, but the day of reckoning is going to come. Record debt is not a sign of a healthy market, and all it means is that the hangover is going to be significantly worse the longer the punch bowl remains, and it's spiked with sugar, spiked with vodka, spiked with absolute, abstinence, and all that stuff, right? You're going to wake up one morning and just be like, whoa, what happened? My head is spinning. And again, going back to here, just reading this one more time, now with that fresh eye of Jerome's been here, done that before. Let me make sure people can actually read this. So I'm just going to move this over a little bit here, make sure you can actually read the whole thing. Intense market volatility has swayed the Powell Fed before. Officials paused after raising rates in late 2018 in the face of severe swings in stock and bonds and cut rates 3 times the following year. I think what Jerome Powell is likely going to want to do this time is that they're not going to be able to normalize as high as they were last time. I think they got to 2.5%, which means that this time probably going to be maxing out somewhere between 1.5 and 2%. So it's going to be a gradual raise, and in my opinion, would be the blow off top before the inevitable drop, which is going to happen. They're going to try to delay the problem. I don't know if we're going to fix it. And I think Jerome Powell learned from 2018. It doesn't mean he's not going to do it again. It just means that he's seen this movie before recently. I've never traded through 2000. I don't know what it means to trade through a blow off top, but I'm guessing that this is what the market needs to set it up. The bond market's flashing a warning. If Jerome says, haha, here's the punch bowl back, I think the bond market's going to recalibrate. Stock market's going to advance dramatically. It's going to happen fast. People won't believe it. And that's how a blow off top is created. People buy the top. I appreciate you watching. If you wouldn't mind smashing the thumbs up as you're signing off, and again, dropping me a comment, I would really appreciate it. I wish you all the best of luck this week. And as always, thank you for watching.